I'm trying to piece the puzzle together. Typically, when the dollar weakens, money flows back into emerging markets, and when yields fall, it further supports risk on sentiment for emerging markets. Right now, the dollar is down, yields have started correcting, yet we are not seeing a clear reversal in the flows. So, where is the money going?
I don't think you can look at that correlation on a day-to-day, week-to-week basis. I think, these are longer-term patterns. There are some investors who are investing based on I shouldn't even call them investors. There are some investors who trade day in and day out. Maybe those are the hedge funds. And there are those who invest and hold positions for 5 years and 10 years. This dollar strength up, down, one day, one week, those are all the things for position traders to reallocate. Those are not factors which drive long-term capital flows. I would broadly agree with you that over the medium to long term, a very strong dollar over a sustained period of time, high US yields becomes a magnet for capital to flow to the US rather than capital to flow outside of the US. What we don't realize is that the US is the biggest recipient of FDI. The US is the biggest recipient of foreign capital debt inflows, and the US is also the recipient because it has such a wonderful stock market, the biggest recipient of FPI inflows into any geography, right? So when you have a strong dollar regime, it basically drives all these factors. If you see some weakness over a sustained period of time, then I think the outlook for capital flows might get slightly different. But again, I'm saying, these are all factors that keep changing. We have seen weak dollar, still capital inflow not coming. That also I will find you examples on a chart. So I would say act with what is within your zone of knowledge. What is within your zone of knowledge is what you should act on, which is your asset allocation, your financial goals, and where are you in the valuation cycle.
Sure, Vetri, it would be interesting to see those charts. But building on the flows, there has been continued selling pressure from FIIs. Is this primarily a result of India versus China dynamic, or is it more about a broader shift in global flows, with capital moving from emerging markets to the US, leading to India's share of FII outflows?
So my answer to this would be, do Indians eat rice or do they eat wheat? Right? As you go from north to south, they tend to eat more wheat, and then as you come south, it's more rice. If you go west to east, again, the west starts with eat more rice in the east. India is a diverse country. Even foreign investors are very diverse set of individuals. Some people are asset allocation driven. Some people have templates which drive their allocation. Some people are hedge funds. Some people are trading for beta. So it's very simplistic to say, oh my God, somebody is moving capital because of China. It's possible some hedge funds who really trade in and out very dramatically, they may have moved capital. But I don't think that is the template that long-term investors follow. But very quickly, I think two things have impacted India in recent times. One is that, which you rightly pointed out, but I don't think it directly affects India. When you have a very high US bond yield, bonds become a valid investment for any international asset allocator, and that to my mind is pulling money out of all stock markets into bonds. That's point number one. Point number two, the US has become a giant sucking machine of capital because it is now 55 to 60% of global equity benchmarks, and it is doing so spectacularly well. If you rank all equity markets by valuation, US will be right at the top in terms of valuation. India will perhaps be somewhere just below that, right? Now, when you have got these two expensive markets over there, it is a career risk for any asset allocator to go significantly underweight the US because it is 55-60% plus of the benchmark. India, 2.5-3%. Okay, I need to take some risk about on valuations. Let me do it in a smaller market. Honestly, my belief is with the valuation correction that we have seen in the market over the last 6 months, and remember in dollar terms, it's almost 4% more than it is in rupee terms. I think when you see the large cap market trade in attractive territory, you will automatically see some foreign interest come back into the market because remember, in some senses, some of these foreign investors have a longer term memory of India than even people who've entered the Indian equity market in the last 3 to 4 years. I know fund managers who've been investing in India and still investing for 30 years. I think if the valuations are attractive, you will see them return far more aggressively than you've perhaps seen in the past. But valuations need to be attractive, both absolute and relative, for them to change their stance.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.